Hey, good morning, guys. This is my morning video. I don't typically do these during the week, but with the Fed coming out today, I thought I'd mention it. So basically, I'm looking at the ZNs. These are your 10-year bonds this morning. And the perception is from the media that we've already fully priced in the 2.5 basis, uh, uh, um, 250 basis point, I think that's what it is, move. So basically, yeah, we haven't even started moving the curve yet on the bonds. You know, the Fed's way behind the curve. Today, we're supposed to start the first 50 basis points, and the bond markets have already priced in a lot of that, and they're saying the media is saying that we've probably priced in the entire move. We may have, we may not have. I don't know. I mean, so basically, for the rest of the week, there is a decent chance that they're going to at least hold this level on the bond market. Maybe get a little relief rally in the bond market, just getting the Fed behind us. That's the perceived perception here, that the bond markets might catch a little reprieve in the next few days. Since we've finally kicked off the rate hiking cycle, which we technically haven't even started till today. So, that's one of the main takeaways that I got going on in today's session. So, a real quick rundown here. So, I do want to point out here. So, basically, the outliers here, this is the 10-year right here, and this is the 30-year. Okay. So, we got a little bit of inversion here going on. Inversion, they call it the inverting of the yield curve. That's really the only ones that are standing out here that are inverted. But ultimately, if you're going into a Fed uh, uh, rate increase cycle, this is your front end of the curve right here. Okay, typically what the Fed has to do in a rate heightening cycle, these right here explode. Okay, this is what a typical rate heightening cycle calls for. Okay, and what that does, it causes the a yield curve inversion. Okay, and in most rate heightening cycles, that's what you see happening, and we're not even seeing that scenario happening yet here. Okay, so just be aware of that situation going into today's uh, uh, Fed meeting. What typically does happen to stave off inflation. If it's a systemic inflation issue, you do have to see the front end of the curve catch a significant inversion, over the long end of the curve, at least in the short term. And we saw it a few weeks back. We saw a lot more inversion going on, and now it's coming off a little bit. But right here, right now, this is just pretty much status quo for the most part. Your typical run-of-the-mill uh, rates going on the bond market, with just a few little outliers on the 10 and the 30-year. Okay, so I just wanted to float that idea here going into this week, that you know this thing can get a lot worse than it currently is. Okay, so yeah, everything just kind of looks a-okay right now, but the issue we got going on here, and what's really plaguing this market, is crude oil. Okay, guys, because crude oil, just a few million barrels a day disruption could dramatically change the atmosphere of the markets. Okay, because they are one of the largest inputs for inflationary pressures. Okay, so I do want to float that idea going forward here. So some main takeaways that I want to go into this week. Okay, so the markets are kind of priced in. Everything's looking good this morning in the markets. What I want to really float here, this right here, this line represents the daily pivot breakdown from that last swing high. Okay, and we're right there. We are right at that daily pivot breakdown scenario. Potentially bull flagging here for a further breakout here on our crude oil. So if the markets were a-okay and everything was looking really good, wouldn't you think you wouldn't be on the verge of breaking out in crude to higher prices? That's a scenario that I want to float in the back of your head. All of a sudden, Europe's coming out saying we're going, we're the NYMEX sweet crude, the light sweet crude. We're going to come in here and we're not going to buy from Russia anymore. Going into the end of the year, we're going to get everything. Everybody's going to be jumping on board on the same bandwagon. And cut one major supplier, Russia was given about a quarter of the world oil supply, and they're effectively being cut off in the Western world. And this is all inflationary to crude. So what's happening in the bond market. I know we are at a support area on the bond market right now, but this can very easily become new resistance, in my opinion, because we're just starting the rate hike. Okay, and always keep it in context here, where we are at relative in the cycle here. This looks like a left shoulder. This looks like a head. Okay, because we went up so fast, and we are in exceptionally uh, uh, an exceptionally uh, uh, steep slope here on our uh, trend. So bottom line is your primary trend is clear right here, right? This is your primary trend on the other markets. So this is your long term trend of the markets. We had all that government stimulus with the whole COVID thing, and it just makes sense to be coming back down into this channel. This is your long term trend. Until you break this channel, the markets are still bullish. Okay, guys. But look how far down you got to go just to get back into the channel, bottom low of the channel here. You're looking here, going into summertime here. Going into summertime. 3,100. We're at 4,100. That's 1,000 point decline, and you're still even at 3,100. It's still a bullish market. Okay, so I mean, we have the potential of 1,000 point decline here. I mean, I don't know. We'll see what happens, but everybody keeps trying to buy this dip, and I don't know. This seems a little ridiculous, but I don't know. So this morning, ES is trading above our breakdown signal. So we had a breakdown signal. We even tried to go below it yesterday, the 4131 area. Okay, we could easily come back to that today with Fed speaking. So be aware of that. So we'll just keep this on very close watch going forward into today's session. Right now, everything looks fairly bullish here. I don't know where my daily is. Where's that at? There it is. We got to move that back up again. And but yeah, so what's going on here? We saved critical support yesterday. We came right down to it, back tested it, and we saved it. We're trying to stair step a little bit higher this morning, so be aware of that. If we take out yesterday's lows, we're in a lot of trouble. So that's how close we are to the edge of a trouble here. So be aware of the situation. So another takeaway I want to have here: we know interest rates are primarily bearish for tech. We still have not gotten below the critical break line. Okay, so even with today's pop in the market, we're still down below the breakdown point. One of our critical breakdown points. So be aware that we're kind of in this digestive area, which we're on the way up, and we're right here, and we might be basing for another leg down, possibly before even the end of the week. So just keep that in the back of your mind here. That it's looking constructive, but it's not. And this is another one, very extreme here on the move up. You're going to 20-year. Which one here? It didn't pop up, I don't think. 20-year. 20-year at 2-year. 1 second here. Let me find it. So just keep things in context. Your long-term trend support for NASDAQ, is way down here around the 190 area. So just keep that in mind. We're currently trading 318. So, that's a considerable haircut here. Yeah, so be aware of that situation going into this week. And, here we are. We're fighting the 2021 Open going into the Fed minutes today, the Fed news today. Very easily, we could be losing the 2020 this year's Open on today's news. So be aware of that situation. I know everything's looking hunky-dory here in the pre-market, but it's a lot of risk going into today. So be aware of that situation, in my opinion. So here we are. There's the 2021 open. Yesterday we were below it. Now we're just trying to hold right above it. So just be aware how close we are to, potential starting a much more, a larger move to the downside here. So definitely keep that one on watch. And then last one here is my ready. And that's another one. We're still below. We had a critical breakdown. We're below the 1963 area. That's your critical breakdown point. We're right down here, possibly bear flagging for another move lower. Currently today, this morning, we're trading right at critical support. Now that's critical resistance. So we're opening the session, possibly crossing over critical resistance for the IWM. Okay. So this one here is acting the worst of all of them. So, we did have, the past couple of days had a really nice responsive bounce. But, this thing here was sold down the hardest too. So keep that in mind in today's session. So that's all I'm going to say. I'm going to keep it simple here. Pretty much Lyft is getting destroyed this morning, down 25%. Obviously, they're not paying their drivers enough, and they just don't. Nobody wants to work for them because uh, Uber came out. They beat on earnings, so obviously it has an internal company problem. I would say it has something to do with pay, their labor pay. They were just being too tight on their pay and stuff. And then AMD, keep that on watch as well. We're up. I do want to point out something on that, and I'm going to call it quits. So we are at a 2 standard deviation move already. Beyond the expected move, our expected move was down here, $91. Okay, we're trading at 96, 97 already this morning in a rate hiking atmosphere. So be aware of that situation. I'm looking for it to possibly fail, not rally. So keep that in the back of your mind going into today's session. Okay, thanks a lot. So one thing I do want to point out also, first of all, the Soxel, that's one of your semiconductors ETFs. We are getting a change of pattern on that initially to the bullish side this morning. So be aware of that. Something. And you had this SOX also. That's another one here. That's the bearish. Uh, that's your bearish SOX. That's your bearish 3 time. Possibly, we could be the bear side could be breaking down. So just keep that in the back of your mind here. If they hold these, like I said, if they hold the bonds up today, that could be a little bit bullish for the tech and take a markets even for one last hoorah to the upside.